Hey, it's Jim, and this is level 3 of the CFA program, the topic on equity investment, and the reading on overview of equity portfolio management. Let me begin this recording by apologizing for keeping you for almost 2 hours in that last fixed income recording. Man, there was a lot of stuff that we covered and a lot of great potential exam questions, so I sure hope it was worth it. Let me go ahead and begin this reading and this recording by telling you I won't keep you nearly as long. This is a much shorter reading, and in fact there are only 8 problems at the end of this reading. I'll talk about those once we conclude this slide deck, but clearly the title, Overview of Equity Portfolio Management, I'm guessing the Institute could have almost retitled this reading, You Already Know Much of This. Notice that we're going to put away our calculators, 5 LOSs, that action word of describe, and I'm guessing that we know much of this stuff here. So I'm going to go ahead and try to swim through this as quickly as possible, and then we'll talk about those questions at the end of the reading. So what was this title? Overview of Equity Portfolio Management. What does that mean? Role of equities, how it's segmented, what are its benefits, what are its costs, and then passive and active strategies. So what I want you to do is I want you to go ahead and raise your hand during the course of this recording and say, hey, Jim, that's something that I didn't know. I, of course, won't be able to see that, but somewhere in there, hopefully I'll give you a nugget or two that'll help you on the exam. So let's go ahead and do a brief recap. I'm going to give you just a quick lecture that I give my students, and this should set us up for the rest of this slide deck. What do we know about businesses? What do we know about large corporations? They issue debt all the time, and the executive leadership team makes an explicit promise to the bondholders. I promise to pay interest, I promise to pay principal. Now that promise over on the bottom right-hand side of the balance sheet is completely different. The promise made to shareholders. The executive leadership team says, I promise that I might pay you a dividend, and you might be able to go to the New York Stock Exchange and buy low and sell high, generating a capital gain. Those are 2 tremendously different promises made on the right-hand side of the balance sheet. Now, because the promise to the bondholders is an explicit promise, bondholders are not really interested in high risk. Bondholders are only interested in receiving their interest payments, their coupon payments, and then receiving their principal payment at maturity. So the return, the expected return on investment in fixed income securities is about this much. But when clients come to us as good wealth managers and we craft this policy statement, a lot of times they say, you know what, Jim, this is not enough return. We want this much return. So look at that top arrow point, primary component of investors' portfolios, because the only way that we can satisfy our clients' risk and return objectives is by investing in equity securities, which are going to give us a much higher expected return than fixed income securities. So what do? We invest in these equity portfolios. Essentially what we're doing is investing in the economy. When the economy grows, then each of the firms inside of our portfolio has more opportunities to invest in positive net present value projects. So when our firms invest in these wealth increasing projects, then we have a better ability to buy low and sell high. There's Jim's summary of a brief recap. Notice at the bottom there, historically outperformed other major asset classes, mostly because of what I just described, with that reliance on the economy and the risk being taken by the shareholders who are owners of the business. All right, so what do we get out of this? Well, this is the vague promise. Go from roles of equities, go northward to dividend income. So we said that. Go leftward, capital gains or capital appreciation. And then there are some benefits to that. So we like dividends, we like capital appreciation, but because we're going to invest in a well-diversified portfolio, that must mean that there are correlation coefficients between and among all of the stocks in our portfolio. We're going to get some benefits of diversification. So remember that if your client comes to you and says, hey, I'm invested in Walmart. I love Sam Walton. I want to continue to invest in Sam Walton. And your client says, what I also want to do is I also love shopping at Target. I want to diversify by investing in Target. Well, who knows what the current correlation coefficient between Walmart and Target is, but it's probably at least 0.8, might even be 0.9. So the point is there are still some diversification benefits. Now they are rather small, but there are some diversification benefits. So then it's up to us as good wealth managers to say to our clients, well, we like Walmart and go ahead, let's buy a little bit of Target, but let's do something else. Let's find stocks that have lower correlation coefficients. And then those of you who are currently living in 2023 will know that there's lots and lots of talk about inflation because there's lots and lots of pain when we go to the food store and Target and Walmart, by the way. So Equities provides some measure of an inflation hedge. Now remember, it's not a perfect inflation hedge, and we're not going to have that perfection that we desire when we go to the derivatives market to try to lock in a future value of our portfolio. All right, so I just said this here, dividend income. We probably don't really want to rely entirely on dividend income to be a source of return, mostly because there are consequences to receiving a dividend. I mean, the first thing is the obvious notion that corporations are subject to double taxation. Corporate income is taxed, and then if those retained earnings are passed then along to shareholders, then the shareholders have to pay a second tax. I always ask my students, what should the corporate tax rate be? And I get some answers, and I say it begins with a Z. So you got to worry about this double taxation. And then you have to worry about other things like reinvesting your dividends. You have to worry about signaling. You have to worry about agency costs. We talk about that in many parts of the CFA program. So look at that bottom bullet point there. This is a good testable question here. Dividend yields are probably higher under value stocks. Capital gains, on the other hand, this is the buying low and sell high. I mean, think about it. If we buy a share of stock today for 100 and we sell it in, 3 or 4 or 5 years for, let's say, 135 or 145 or 155, we get a 40 or 45% rate of return capital gain. Maybe we got a $2 dividend in there, maybe a $3 dividend. So that dividend as a percent is going to be way lower than that expected capital gain. Now look at the second bullet point. I think this is probably a good exam question. Less stable due to volatility. What do we know about stock prices? They go way up and they go way down. So the element of timing plays a role in our responsibility as wealth managers. And then there's the opposite question that I said over on the left hand. So capital appreciation is more common among growth stocks. That makes perfect sense. There's a beautiful table inside of this reading identifying correlation coefficients between and among a whole handful of stock indexes and then some other asset classes like maybe a REIT. And it's fascinating to see these correlation coefficients among equity indexes are so high. If you look at it, 0.75, 0.85, 0.92, like that. So remember, we're still getting some diversification, but not lots of diversification. That's why we have to diversify across asset classes. We like equities, but how about if we do large cap equities? And how about if we do small cap equities? And how about if we chop those into several different segments, which we'll do here in just a couple of slides. Now, that second diamond point, I'm guessing that you have lived through this. I know I have, and I have conversations with my colleagues. Even my son, who just has he's currently 24 and just started a retirement fund through his employer, and he goes, "Dad, I just lost $300 in the last couple months." And I was like, "Dude, this is called." Thank heavens you're only 24 years old. Imagine if that was $2 million and you were 65 years old. This is what we know. When asset prices are exposed to a market crisis, then those correlations, they all converge. Now, they're not going to be 1, but they're all going to be 0.7 and 0.8 and 0.9. So when we rely most on those low correlations to deliver us from the pain of a market crisis, it just falls apart. So that second diamond point is really important. That's why as good wealth managers, as good financial analysts, we need to make certain that our clients are protected in the event of a market crisis. Didn't we just have a conversation on value at risk and managing the lower left tail of the return distribution? Well, that's essentially what we're talking about here. But while we did it with fixed income back in those previous recordings, we're going to do the same thing, not in this slide deck, but we're going to do the same thing with equity portfolios. All right, here's a good slide on this inflation hedge, and right at the top, I'm going to go ahead and repeat what I said. Inflation hedge, it's probably not going to work when exactly we need it, but there are real pockets here of advantages. So read that here. Firms that can raise their prices when their input prices rise. So go ahead and scratch your head and ask yourself, what firms are able to successfully pass along their prices? Well, the answer to that is those firms that have brand name product lines. I mean, there's no way that in the course of managing our household that my wife and I are going to not pay that premium, that premium for the brand name just because inflation is soaring around us. Now, other individual consumers may feel a little bit differently, and there might be some substitution. In fact, this goes on at the food store all the time. Now, I'm a big soup guy, and I like my Campbell soup and my Progresso soup. And then I always have there's the store brand right next to it. And I look at the store brand and it's 50 cents less or 75 cents less a can. And I'm like, there's no way I'm buying that thing. So brand name product line. So remember that. That's probably a better hedge, but it's not going to work with lots and lots of other firms. Like if I'm Jim's Soup Company, right? Who's going to buy my soup anyway? What do I know about chicken noodle soup? So there we go. On the right-hand side, price-sensitive customers. And so when my wife goes shopping with her mother stands there and looks at it and she compares everything. She could stand there for 30 minutes comparing all these prices. And my response is, boy, time is equal to money. So let's go ahead and move on with our lives. Now look at the bottom there. Equity is generally a better inflation hedge than fixed rate bonds. Of course, if we own a fixed rate bond, we're just getting that fixed coupon rate. Suppose it's 5%. So no matter what happens, we're getting 5%. But as soon as inflation hits 6% or 8% or even 4%, then we start thinking, wait a minute, what is our real return on these fixed income securities? And so this whole idea of an inflation hedge typically means that equity securities offer that capital gain so that you can capture the right tail of the distribution, which works to manage inflation better. Now, I've said this multiple times in these level 3 recordings, is that we need to focus on the role of the policy statement. So what do? We have risk and return objectives, and then we have all of these constraints: time constraint, tax constraint, liquidity constraint, and those unique circumstances. And I'm going to go ahead and just repeat this. I've said this to you guys before, but when I teach this to my students, I have a 6th constraint, and that 6th constraint is a behavioral constraint. Now, the Institute hasn't done that like I do. They're going to go ahead and lump that into the unique considerations or the unique circumstances constraint. So be aware that anything that doesn't go in those first 4 constraints will probably go into that unique one, and it could be behavioral issues. It could be, look at the bottom, ESG considerations. But the idea here is that we interview a client, we get to know our client intimately from a financial perspective, and it's our responsibility to find cash, fixed income securities, equity securities, alternative investment securities, and any other thing out there that's possible to be able to deliver, right? Because our client comes to us and says, you know what, I have a bunch of money, I don't know what to do with it. Here, you take it. So we have to act as good stewards of the investor's capital, and we need to make certain that we are aligned with their risk and return objectives, which means we have to be sensitive to time. And remember that time is typically broken into various stages. Tax situation. So, oh my gosh, there are countries out there where the dividend tax rate is different than the capital gain tax rate. So depending on those two differences, we may have clients that prefer value stocks. We may have clients that prefer growth stocks. And then liquidity needs. Remember, these liquidity needs are generally one-time lump sum cash outflows that are required or expected in the relatively near future. I always tell my students that the accountants have told us back since we were 18 years old that, short-term is 1 year or less, long-term is beyond 1 year, and that's probably an okay way for accountants to think. But, suppose you have a client that comes to you and says, my daughter's getting married in 370 days. And I want to be able to spend $100,000 on her wedding. And you think like an accountant, well, that's long term, so therefore I'm going to invest in all these crazy high risk, high standard deviation, high beta equity securities. And then we have a market crash on day 364, and you have to go back to your client and say, well, your daughter, she can go get married in your backyard, and there can be no photographer, and there are no flowers, et cetera, et cetera. So those liquidity needs are major one-time lump sum liquidity events, like a daughter's wedding, like college expenses. You can do present values in there. And so there are all sorts of ways to manage those liquidity needs in the context of the equity portfolio. Now, as you know, the Institute is very big on these ESG ideas. And so what they've done here in Level 3 is combine what we did back in Level 1 with the screening process. So we can do negative screening. I'm guessing you know what that is. You can do positive screening. You can do thematic investing. You can do impact investing. So I'm guessing that you should know each one of those definitions. And this sounds an awful lot like a great question where in the question stem, you have an analyst who makes a comment. Comment number one would be something like, hey, I'm identifying this particular company because they invest in only carbon-free positive net present value projects. This would be an example of, and you would have negative screening, positive screening, or impact investing, and you would pick positive screening in that example. I said this just a few moments ago, right? We can take our whole entire equity universe and we can chop it however we want to, right? Size and style, geography, economic activity, combinations of those three, or anything else that we want to. We could chop the equity universe into quality of the board of directors or the skill set of the executive leadership team. Now, I'm not quite sure how you would identify that in a manner that is not quantitative, that would be reflective in some of these other segmentation processes. But you know what? We studied quantitative methods all the way back from Level 1, so we ought to be able to come up with a factor analysis that would enable us to do such a thing. All right, this is what I was saying earlier, large cap, mid cap, or small cap. So what do we need to be concerned about? If we invest in large cap stocks, what does that probably mean? Let's just pick a large cap stock, Milton Hershey. If I go to the floor of the New York Stock Exchange and I'd say, hey, I want to buy or sell shares of Milton Hershey, what's going to happen? There will be lots and lots of people come. So, there'll be tons of liquidity for large cap stocks. But if I go in and say I want to buy or sell Jim's Concrete Company, who knows about Jim, right? I'm just some dude who has a concrete truck and I go out and I make sidewalks. Oh boy, thinly traded. So there's probably going to be wide bid-ask spreads. There's probably going to be severe adverse selection costs and all sorts of bad things there. We can do this by style, value, or growth, or some kind of combination. And here's the investment box. This is the Morningstar box. I'm sure that you've seen this maybe 1 million times during your lifetime. But look up at the top. What we can do is we can look at growth stocks and we can look at value stocks, and we can try to combine what we've done back in Level 1 and Level 2. Remember, we spent lots and lots of time talking about relative value analysis, We did other kinds of stuff. So of course we're going to look at, and I'm not a gigantic fan of price earnings ratio, although that seems to be like the most popular. I'm a much bigger fan of price operating cash flow or price free cash flow, because as a good finance professor, I teach my students every day, no matter what class that I'm in, is that Modigliani and Miller taught us all the way back in 1958 that you measure the quality of a firm by its ability to generate sustainable cash flow. So the price cash flow ratio is probably more meaningful to me, but everybody loves price earnings ratio because it's available, like that. And then I always tell my students, of course, no matter what kind of style you're looking at, whether it's large cap or mid cap or value or growth, you need to take a look at what's happening over time. So trend analysis is super important, but the reading goes and emphasizes that it's probably more important for growth stocks because of its impact on the buying low and the selling high. Now, there are lots of different things you can do with this Morningstar box. You can draw some graphs. You can do all sorts of fun things in there. So what are some advantages of all of this segmentation? Well, you just think about it. If you have, let's just suppose there are 10,000 stocks traded in the United States. So you throw those into a big circular bucket, and you look into that bucket, and you see all sorts of stuff in there. But if you pull them out and you put them into different kinds of boxes or segments, then what you can do is say, oh, I have a client here who has this liquidity, this tax, this style preference, a daughter who's going to college, or what did I say, getting married in 370 days. I have this, and you can reach into that segment and say, oh, here are 6 firms in that segment. Let me find the best firm. Of course, then when we pull all of these segments out, we have a greater potential for diversification. Now, of course, we have to confirm that diversification. We can't just say, oh, I'm investing in Milton Hershey and Jim's Concrete Company. That correlation has to be low. It's super easy just to go to Bloomberg and pull off daily stock prices for both of those, download those into an Excel spreadsheet, hit the correlation function, and you can calculate that over the last, month or year or 5 years, whatever it is. So my advice, this is more practical than for time and exam purposes, is just go ahead and compute the correlation coefficient. Yeah, look at the green one there. This is so important. We spend a lot of time in fixed income and then in equity doing factor analysis. And so we can extract some factors from our segmentation, and we can look for those performance benchmarks and say, okay, we have this segment over here, and this has applied to our client over here, and then we compare those two. Yeah, a small cap company, if it's successful, is sooner or later going to become a mid cap company, and then it's going to have brand name product lines, and it's going to become a large cap company. That's pretty obvious. How about geographical segmentation? You can do this a variety of ways. The reading says, let's look at developed markets, who they are. Emerging markets, who they are. Frontier markets, who they are. I always tell my students that when we talk about frontier markets, I always mentioned Slovenia because 3 of my grandparents were born there. Now, we've mentioned this before about this concept of home bias. And my mother was tremendously guilty of this during her investing life. She liked to invest in companies that she knew and where she shopped. So she owned Walmart, she owned McDonald's, and Procter and Gamble, and all those kinds of companies. And I would say to her, Patsy, that was my mother's first name. Patsy, you have this home bias. Now you're benefiting because these companies that you invest in are global companies. So you're getting some benefits of international diversification. But I said, at some point, and I come from a very humble background. So these were just, maybe, thousands of dollars of an investment that my mother made, not millions of dollars. But I said, you know what, if you ever hit the lottery, we're going to go ahead and we're going to invest in a German company, and we're going to invest in an Egyptian company and a Slovenian company to get that international diversification. So my advice to you guys, as you're taking the test and reading through client descriptions, and there's this notion of segmentation and home bias and international diversification, always go back to, let's go ahead and think of my mother Patsy and informing the client, educating the client, and say, you know what, here's what you're doing domestically. It might be possible for us to do more if we go outside of our geographic boundaries. Maybe we'll get higher interest rates. We'll have to take more risk. Maybe the beta of our portfolio will fall. I mean, we don't really know that. Maybe it'll go up, but we've got all of these possibilities. So do you see how educating your client makes them and us better partners inside of this policy statement relationship? I think I mentioned the advantages and the disadvantages there. Look at the bottom one. We have to worry about currency risk. We just spent lots of time in our fixed income recordings where I always say something like this, especially with investing in developed markets. You can find portfolios over here and portfolios over here, Canada and Germany, and you can find securities that have low correlations, but maybe the Canadian dollar and the, Germany and the Euro mark and the Euro, maybe they have correlation coefficients of 1. I mean, they don't, but maybe they do. So you have a natural benefit of managing that currency risk. And of course, it's not going to work perfectly like that. So really all you do is call up a financial institution and say, hey, I want a forward contract. All right, how about segmenting by economic activity? I like the bottom one here, production-oriented approach. One of the assignments I give my introductory finance students, they have to pick a company, and then I ask them to describe the product lines, the major product lines for this company. And I tell them, you don't have to describe it, just cut and paste a picture of their product lines. So I get students who do Harley Davidson, so I get a bunch of pictures of motorcycles. And so I'm teaching them that this is one way to segment. So products manufactured or the inputs required. I'm going to give you guys a homework assignment that have access to Bloomberg. You guys use the supply chain function. This is so cool. So you go to the supply chain function and you type in a company like Amazon or Microsoft, and that company will appear in the middle. And then there'll be a list of all the companies on this side of the supply chain and all the companies on this side of the supply chain. And so you can use Bloomberg to segment both sides of that supply chain, which really lowers our investment and our research costs. Thank heavens for Bloomberg, right? Now, skip up at the top. You can do this on a market-oriented approach or a market-based approach during, each market or the way customers use their products. And of course, this is so important for online consumption. I ask my students, I say, look, would you be willing to pay a premium if when you went to Amazon and you clicked on something and say, I want to buy it right now? So whatever it is, maybe it's earbuds, right? Maybe it's a book, although I don't think my students read books. Maybe it's a financial calculator, whatever it is. And then you could hit a button that says, I want this delivered in an hour. And so you click on this button and you pay an extra $5 or $10 or whatever it is. And then you go out to your backyard and you go like this, and a drone drops your product into your arms. And my students say, you know what, I'm sure someone's working on that. I'm certain that people are working on this. But, so that's one way to segment the market-oriented approach. And so you can do this through almost anything. My boys, when they leave practice and they're starving, they always like to stop at McDonald's before they get home. And they just order, on their phone. They get to McDonald's and it's right there waiting for them. So there's another way to segment. Yeah, what are the great advantages here? Let me go ahead and mention this so we can do this. Specific sectors and industries and economic activity, and then that allows us to construct some kind of a benchmark that is way more relevant, right? We don't want to just pick the S&P 500 index because that's relevant only if we own the Vanguard 500 index fund. Some disadvantages, large companies that do all sorts of stuff. Take a company like Johnson & Johnson. Do you put them into the home hygiene product line or industry? Do you put them into the titanium hip? I have a replacement hip here on my right hip. I have a Johnson & Johnson titanium hip. Do you throw them in there? Or do you put them into the vaccine group? That's a tough one there. Equity indexes and benchmarks. Yeah, we've talked about that. You don't need me to say anything to you. Here's another couple of examples that we can divide this by sector or industry or product line. I mean, we can segment this any other way. Once again, the Institute feels obligated to mention the ESG practices here. All right, how can we generate income? Well, we get the dividends. We can lend our securities. Remember, we did this back in level 1, that whenever you buy shares of stock on margin, you give the financial institution the right to lend out your securities for short selling. But you can make the arrangement that even if you don't buy your stocks on margin, that you can make them available for lending, which is going to generate income somehow. You can write options. We have lots and lots of readings in level 1, level 2, and now level 3 on option strategies. So when you write an option, you're essentially creating the option. You're essentially selling the option, so you generate income. Let me just remind you, at the risk of offending all of you, suppose I write an option today on Jim's Concrete Company, and it's a put option with an exercise price of $100. What am I hoping? I'm hoping that you guys, you pay me a bunch of money today, so I generate a lot of income. Suppose I generate $100,000 worth of income, and then I hope that I never see you guys again. I hope the stock price goes down, and so you guys lose, and I get to keep all of that option premium. And then dividend capture is really pretty basic, elementary, kindergarten kind of stuff. But the Institute does have a big old paragraph talking about dividend capture. So let me give you just a quick example here. You ready? Suppose the stock price today for a company is $100. And forget about the timing elements of all of this that we know are true. But let's suppose the board of this company announces that it's going to pay a $10 dividend tomorrow. And you have to buy the shares of stock by today at 1 o'clock. Suppose it's 9 o'clock in the morning right now. So the share price is 100. They make the announcement. So if you want that $10 dividend tomorrow, you have to buy the shares by, 1 o'clock today. So as we get closer and closer to 1 o'clock, notice I'm doing the old time clock, not the digital clock. So it goes like this. And as soon as we hit 1 o'clock, so at 12:59, that price is probably going to be $110. But as soon as it hits 1 o'clock, it's probably going to fall back to $100. So you try this dividend capture and take advantage of the timing issues, because we know the board makes an announcement today and they'll say something like, you know what, it's about time we pay a dividend. We're going to pay it in 30 days. And you need to own the shares in 28 days. So, there's some time element that goes by. So it's possible to capture that dividend and not get penalized by the fall in price. Yeah, firms' dividend income. So why do we like dividend income? What are the benefits to us? What are some of the impacts as good wealth managers in what our clients should know? Yeah, what do we know? The firms generate a net income, and that net income gets swung over to retained earnings. So you would think there would be lots of cash flow. So dividends are paid out of, and that's discretionary from the board of directors. Remember I said earlier that vague promise made to shareholders is, hey, I might pay you a dividend, but I don't have to. And if I don't pay you a dividend, you can't sue me like the bondholders can. Primary source of income, we said that. Have less significance to growth investors. We said that. Special dividends and regular dividends. Special dividends, of course, are non-recurring. This is what we know about dividend policies. If a firm pays a quarterly dividend, it's going to do everything in its power to maintain that quarterly dividend because shareholders are used to that dividend. And this is what we know. I said this to you before, not that this is important or I'm not self-praising here, but I wrote a couple of academic articles about dividend policy. And this is what we know. When a firm cuts or omits a dividend, whether it's an annual dividend or a quarterly dividend, stock price gets hammered. Shareholders do not like dividend cuts or omissions. And so executive leadership team does everything in its power to maintain that dividend. Now, if a firm pays a special dividend, boy, this is really good news because the firm says something like, you know what, I'm going to reward you shareholders for being owners of the company, for providing us capital whenever you did back in the old days, and we're going to reward you with a special dividend. Now, it's special. So don't think that this is going to be part of our regular dividend. Now, some good academics, including me, might say to anybody who would listen that a special dividend might not be the great signal that I said just a few moments ago. It might be a signal that the firm has no positive net present value projects in which to invest. But that's a conversation for dividend policy readings. Yeah, look at the very bottom there. Legally, companies are not required to pay a dividend. So this is what I was talking about. I don't have to pay a dividend. I might not pay you a dividend. And what else can the executive leadership team do? Or in this case, the board of directors, they can declare a stock dividend or they can declare a stock split. I think I taught you all about that back in level 1. Here we go, securities lending, part of short selling. So what do? If we want to short sell, pick up the phone and call the investment banking firm and say, I think Jim's concrete company, which is currently selling at 100. I think Jim is a terrible executive. I think he makes terrible capital budgeting decisions. That stock price is going to fall to 50 and 30 and 20. I want to short sell. And you say, I don't have any shares. Can I borrow them? So, of course, you'll borrow those shares. You'll go sell them on the floor of the New York Stock Exchange. When the price crashes all the way down to $20, you buy it at 20 and you return the shares back to the investment banking firm. And what did you do? You bought low and sold high, bought at 20, sold at 100, but you did it in the reverse order. And so those bottom couple of arrow points, this relates to collateral and margin. Of course, there are all sorts of rules associated with securities lending. I can't imagine the Institute would ask you a question on that. But if it does, you just go through your commonsensical kind of an answer and say, oh, man, sometimes I might need to put up a margin. I might need collateral. Option writing strategy. So if we have a client who owns a particular share of stock, like Milton Hershey, what that client can do is write a call option on Milton Hershey. And so what that does is you have this covered call. So you own the shares, you've sold the call option or you've written the call option. So you generate income, but that limits your upside. You can do a covered put, and there are all different sorts of things there. But remember, I think what the Institute is emphasizing here is that you can generate income. You can generate income by writing these options. Boy, here's this slide about my dividend capture. What was that? $100 all the way up to $110. But here, my example was kind of a silly one day. Here's a good example because we know that there's the announcement date, there's the ex-dividend date, and then there's the dividend payment date. So you need to keep track of all of these dates. So the stock price should decline by the dividend value, but there are other inputs that are at play. Investors oftentimes think that, if the dividend is increasing, this is a signal of good news. And so maybe that stock price is not going to fall by as much as you think because shareholders demand. So look at that second to bottom embedded bullet point. Wow. There are demand and supply conditions that are reflective of the investors, the shareholders, the market's idea of why is the firm making this dividend payment. And then, of course, not all shareholders are exposed to the same tax considerations. So look at the bottom. The strategy is profitable if the stock price decreases by less than the dividend amount. Sometimes it does, a lot of times it doesn't. What would Eugene Fama, who's considered to be the father of the efficient markets hypothesis, he would say in that very last bullet point, he would say, this strategy is never profitable because markets reflect all publicly available information, and any attempt to capture a dividend is going to wash down the street. Fees and costs. All right, so what do we know? It's easy for a client to say to us, here's a bunch of money, and we go out and say, you know what, we're going to buy these 40 stocks. Well, you can't do this for free, right? So you're providing advice to the client, but you might have a management fee, you might have a performance fee, although those are pretty strictly restricted to hedge funds. You might have marketing and distribution costs, strategy costs, trading costs, administration fees. So we'll go through these quickly here in the next couple of slides, but I think it's probably a better way to think of these in the context of a mutual fund manager, where each one of these costs is explicitly discussed in the prospectus. All right, so management fees based on style. All right, so actively managed portfolios, these things are probably going to be fairly high. Passively managed portfolios are going to be way lower. Isn't there a commercial during the football games that I've been watching lately that says something like, come to our investment banking firm. We have no management fees if you invest in our S&P 500 index fund. No management fees. Performance incentive fees. This is what I look at the very top there. Hedge funds and long and short portfolios. So these are performance fees. And this just says something like, you know what, if I do really, really well, I want to share in my performance. So you're going to pay me. So if I double your money over the course of the year, surely you can pay me 5% or 10% or 20% or 50% of that. Whatever it is, you're happy to pay it to me as long as I perform. Here's just a quick example. I'm guessing you remember this concept of the high water mark, so that we don't pay these fees twice. Let's just go ahead and read this here. January comes along, we deliver 20% for our client, outperforms the specific threshold, whatever that is. So our investors pay us a performance fee. In February, we lose 25%. Oh my gosh. All right, so this is no good. Now, there's no way that we should require our investor to pay us a performance fee, but that second performance fee will not occur until we've made everything back, right? So, let's just do quick math here. We start with $100. So at the end of January, we have $120. So we generate some performance fee, but then we lose 25%. So we're all the way down to, somewhere around $100. Now what are we going to do? We don't have to, our shareholders or our owners are not going to pay that performance fee until we get back over $120 in the value of the portfolio. Administrative fees, these are fees associated with corporate actions. Rights issues, measuring portfolio risk and return, voting at company meetings. When my mother was alive, she used to get these proxy statements, from all these companies, and she would say, "Jimmy, what should I do with these?" And before I could answer, she would throw them out, and I'd say, "You know what? Look, Patsy, this is what I want you to do. I want you to take it out. They give you a paid return envelope, and for the board of directors, write my name in." Just do something silly. Make somebody read it, because when you toss away your proxy statement, you give the executive leadership team the right to vote however they want. So voting at company meetings, this is kind of a big deal, because especially these days after the 2008 financial crisis, we have so many more activist investors, and we'll have a couple of slides on that in just a few minutes. Custody fees, depository fees, registration fees. I'm guessing you know all about those. Marketing and distribution fees. I don't ever give out investing advice to my students, but I'm happy to tell them that my wife and I, the overwhelming majority of our, kind of lifetime portfolio is invested in a total stock market index. So we've got U.S. firms, but we got firms throughout the world. And I can go to the prospectus and I can read each one of these fees, marketing and distribution fees. But what's interesting is that every once in a while I'll get an email from this investment banking firm, and they'll tell me that they're doing really, really great things for me, et cetera, et cetera. So I'm guessing what those fees are. So trading costs, they can be either implicit or explicit. So the explicit costs, these are any fees that you have to pay foreign exchange, any broker commissions. I remember when, back in the very beginning of the internet, were you guys even alive at the beginning of the internet when, we had these ads that say, oh yeah, let's do this trading company, only 1 cent per trade or 5 cents per trade. And I remember my mother used to pay like $100 when she would buy or sell some of her shares of stock. I remember saying, you know what, Mom, you need to think about this when you buy or sell, because that's highly impactful. Now I'm going back all the way to 1980s and 1990s. How about some implicit costs? Bid and ask. There's always a bid and always an ask price. There's this concept of delay. We did this back in level 1. So if my mother would have called up her broker, which happened to be my cousin back in the old days, and say, hey, dude, I want to buy, 100 shares of Procter & Gamble. And my cousin would say to my mom, oh, stock price is right now, it's $100. But, maybe my cousin had to leave work early and go watch his son play soccer. Or maybe my cousin got sick, or maybe, and there was a delay, and all of a sudden my mother didn't buy the shares until they were $103. Boy, delay or slippage, and there's all sorts of reasons behind that. And then we always have to worry about momentum. This is one thing that Eugene Fama said does not exist back in 1966 with the efficient markets hypothesis. But we know, including subsequent research by Eugene Fama, that there are things like momentum, at least over the short term, that goes on the floor of the exchanges and in the over-the-counter market. And so you got to worry about saying, okay, I want to buy this share of stock, here's the price. But you have all these momentum investors who are in front of you in the line, and they all of a sudden bid the price up to 110 or 112, and you're thinking, wow, I didn't really want to do that. All right, so remember, implicit versus explicit costs. This is a great exam question. Passive versus active. I probably don't need to tell you anything that's on this here. So I'm going to go ahead and just pause. I don't think I have anything interesting to say on this slide that would add any value to what you guys already know. Yeah, how about if we're demanding liquidity or providing liquidity? If we're doing this momentum that I've been talking about, we're demanding liquidity, because what we're saying is that, these prices are rising and we're there to buy, right? We're in the buy line, so we want someone that's over on the other side willing to sell. If we're selling shares, then we're just on that opposite side. Yeah, momentum strategies, high market impact costs. That's what I was saying just earlier. Deep value strategies provide liquidity. That's probably a good thing to remember. Low market impact costs, deep value. That's probably the result there. Here's what I was saying earlier, shareholder engagement. I'll tell you just a quick, silly story about my life over the last year. About a third of my dissertation was on poison pill securities. And when that really wealthy dude and Twitter came about, and everyone said, Twitter has a poison pill, and it was almost like no one had ever heard of a poison pill before. So somehow one of my colleagues got wind of my dissertation topic, and I became kind of like the resident expert on poison pills. So this is all about shareholder engagement, and this really has become prevalent, and you guys probably know this as well as I do. After the 2008 financial crisis, shareholders in the academic world, they're typically called shareholder dissidents. They disagree with the executive leadership team, so they do things like show up at annual meetings. They do things like nominate themselves to win a seat on the board of directors. They pay attention to all of these investor calls and in-person meetings, and they just want to become more informed, and they want to say to the executive leadership team, now that I know everything about the company, I still think you stink at this and this and this, so therefore we need to do some stuff. And that's why, one of the reasons why executives instituted poison pills. And remember, they don't call them poison pills because nobody would swallow something that's poisonous. They call them a shareholder rights plan. And these go all the way back to 1980 something. So look under corporate strategy there. So what do? We have the board of directors establishes the strategic objectives and goals, and then guidelines for the executive leadership team to achieve those goals by outlining the resource, outlining growths, outlining constraints. So everything in those last 3 diamond points applies to that information set that I was talking about just a few moments ago. So the dissident shareholders, now they're called activist shareholders. These activist shareholders can say, all right, here's your core business. I think you're doing really, really well. But it's these offshoots that I think you're not doing very well at. So you need me to sit on the board of directors. And so put me on the board slate, and then we can discuss short-term obligations and long-term obligations. We can consider the entire stakeholder group of interest, not just the wealth of the shareholders. Now, of course, this gets into allocation of capital, which is a function of the executive leadership team. And this is the right-hand side of the balance sheet. Do we issue bonds? Do we issue shares of stock? And really, I tell my students this, and I hope that this was informative to you. If you think of the explicit promise made to the bondholders, the vague promise made to the shareholders, this gives you a great context to decide whether we should make the explicit or make the vague promise when we're financing not just wealth increasing projects, not just positive NPV projects over on the left-hand side of the balance sheet, but that first diamond point, mergers and acquisitions. Corporate governance, this is my favorite of the ESGs in the Institute's promotion of this idea. That this is what I know, is that corporations that have best practices for corporate governance and its strategy, these are the companies that are most well run out there, and they are very likely to have the best brand name product lines because they know how to manage all different sorts of risks, not least of which could be regulatory and political risks. Now, of course, if you guys are regular readers of the Wall Street Journal, which I always encourage, you'll know that there's this great disparity between executive compensation, especially CEO compensation, and the compensation of the employees. And so it's up to us to inform the shareholders out there that most of that comes from executive stock options. But clearly there is a committee on the board of directors that keeps management in line. And they say something like, you know what, executives for these competitors over here, they make this amount of money, and therefore we think you are just as valuable or even more valuable, so we'll pay you a little bit more. So it's up to the board of directors to decide on the terms of the employment contract for the executive leadership team, including incentives and including behaviors that are unacceptable. So I tell my students this all the time. You probably remember, hopefully you remember this back from level 1. I tell my students that executives get fired for basically 2 reasons. For incompetence, and that doesn't mean that they don't know what they're doing. That means that they've made poor capital budgeting decisions, right? They've decided to do something and that didn't pan out with more revenues, fewer expenses, and lots of cash flow. So I call that incompetence. And violating the terms of their contract. If you read the Wall Street Journal, you will read, and this is so sad, it makes me so sad, when the two executives, they look at each other and they decide to visit privately, and that's probably outlined and specifically an unacceptable behavior because of all of the consequences. It makes me so sad that people do this. But anyway, so they get fired for violating the terms of their contract. Let me go ahead and give you a comical follow-up. I've said this before, but I think it's worth repeating. When Patrick Mahomes signed his $500 million contract a couple of summers ago, I read in the Wall Street Journal there were terms to his contract. Patrick is not allowed to roller skate. Patrick is not allowed to climb a cherry tree 50 feet in the air. Patrick is not allowed to jump out of an airplane. So they didn't want him getting hurt when he was just doing stuff. And that makes perfect sense. But do you remember last year, I think it was a playoff game, Patrick threw a great touchdown pass and he went to the end zone and the wide receiver jumped on Patrick's back and he ran to the sideline piggybacking. And I guarantee you that the next day, Kansas City owners said, Patrick is not allowed to give piggyback rides out on the football field. So what did I say? What was I saying? The whole point of this, terms of the contract and incompetence. Composition of the board of directors. I wrote a bunch of my dissertation on board of directors. I take my students to the Johnson & Johnson board of director page, and there are 12 or 13 of these really, really smart men and women. If you look at these men and women, if you look at their pictures and just read one sentence about their skill set, I mean, they have doctors, they have accountants, they have former CEOs, they have chairman of boards. I mean, you look at Johnson & Johnson and you think, here, where do we go? Experience, competence, diversity, culture, skill set. I mean, they bring everything to the table. And I ask my students, I say, do you think Johnson & Johnson has an acceptable board of directors? And I tell my students say yes. All right, what are the benefits? These are great exam questions. So there are benefits to the company. This is what I was saying about stronger corporate governance. So think about this shareholder activism or shareholder engagement as bringing to the attention of the executive leadership team and the board of directors a direct link from the issues facing shareholders as dispersed owners of the company. Sometimes you can't see the forest from the trees. My mother used to say that to me, and I have no idea what it meant until I got older. Now, benefits to shareholders. Look at that first bullet point. This is exactly what I was saying earlier. Better understanding of the company. So that gives us better understanding of ESG ideas, benchmark ideas, shareholder engagements, et cetera, et cetera. And then other stakeholders, governments, employees, all these other people benefit if these really, really smart men and women are being taken and challenged for all of their decisions. As a good parent, I try to encourage independence from my children. And when my children have made a decision, I say, all right, tell me why you did this. Go through the steps. And I usually get one step in there that's a good and acceptable answer. High costs, yes, pressure. A lot of times these managers, they'll say this, and you read about this in the Wall Street Journal all the time. And if you watch, any of the news channels, when the executives come on, they have tremendous pressure to meet short-term targets. So that, think about it. There's a quarterly report. So I need to meet the quarterly revenue. I need to meet the quarterly revenue growth target rate. I need to meet. So there's lots and lots of pressure. That's why I try to convince my students, and I'm going to convince you, but I'm not quite sure what advice this means for taking an exam, is to let's go ahead and take a step back and say, you know what? We really shouldn't be worrying about what's happening in 3 months. We need to worry about what's happening in 3 years. That's a much better timeline. Insider trading. So the more shareholders know, the less insider information or non-public information is available out there. So that throws away insider trading. Conflicts of interest. We talked about the agency conflict back in level 1. All right, so activist investment. Let's go ahead for some extra details from what I have suggested earlier. Launch media campaigns, seek to be elected to the company's board of directors, engage in proxy battles. The dissident shareholder or the shareholder activist has very little chance of actually getting a seat on the board or controlling seats on the board. But there are examples of successful proxy contests. So this encourages more stuff, right? Voting, yes. We know this from just our general elections here in the United States. It's important for everybody to vote, just like it was important for my mother to vote, 30 years ago or so. exercise their right to vote on major corporate issues. Yeah, monitoring the performance of board and senior management. I like that. So what about this passive active spectrum, right? Yeah, this is a conversation that's been going back all the way to 1970 with the dude from Vanguard who said, you know what, I'm going to start the Vanguard 500 index fund, and lots of people laughed at him and said, why would anybody want to just earn the market rate of return? But he was way smarter than the rest of us. I mean, he was probably this wealthy back then, and I think he's fairly wealthy today because we love not just Vanguard 500 index fund, but all investment banking firms have mimicked that. So you can buy the 500 index. I probably have one out there. There's probably a Jim's 500 index fund that I don't even know about. All right, so why do we switch then from passive management, which has low costs, right? Lots of diversification, all the good things that we like about this role of equity securities in our portfolio. Why would we go ahead and switch over to active management? Well, of course, look at that first word, confidence. So we need to know something about ourselves. We need to know something about our market. So this is what the Institute is trying to teach us. Look, if we study all of this material in the CFA program, we are going to be, I'm not saying we're going to be the best, but we're going to be among the most educated of financial market participants out there, which means that we have this expert knowledge to match what's going on in the equity markets and its role that it plays in our client portfolio. So that activity, that active management, is going to benefit our client over the long term, clearly not over a 3-month short-term period. So our client is going to come to us with short-term goals and intermediate-term goals and long-term goals. Now, the short-term goals, we're just going to take a present value and we're going to take that fund and we're going to invest it in treasuries, right? So that's not going to be a problem. Then for intermediate goals, like 5 years, we have a daughter who's getting married. Well, we're going to manage that and probably with some fixed income securities. Maybe we'll match durations or match cash flows like we talked about in those fixed income recordings. But then when we have children who are going to college in 20 years or we're going to retire in 30 years, well, then we're going to incorporate all this material that we're talking about, not just in this reading, but in all of the CFA program. All right, so that first block point there, client preferences, this is what I've been talking about all along, about knowing your client, getting to know your client financially, their goals, their aspirations, their fears. I mean, that's really the important thing. What are the clients afraid of? My father, when he was alive, he was so afraid of his portfolio losing value. And he would say, you know what, it's worth this amount, and this month it's only worth this amount. And he would call me and yell at me, and it was like it was my fault. And I was like, dude, you can't do this over the short term. And he goes, yeah, but if I die next week, I want you and your sister to get as much money as you can possibly have. And I'm like, Dad, I appreciate your love for us, but you're really not behaving in a commonsensical manner. I said, look, my sister, she has a good job. I have a good job. We're not waiting for you to die. We don't need your money. Go out and spend it. Go have a lobster for dinner tonight. Don't worry about us. But my father went to his grave worrying that he wasn't leaving us enough money. And as I said with my mother, it wasn't billions of dollars. So. All right, after we do all this stuff with our client preferences, we need to identify a benchmark. So if we're doing passive investing, if we invest in Jim's 500 index fund, well, then we're going to use the S&P 500 as a benchmark. Now, if we're active, then we need to find the benchmark. Now, a part of it might be the S&P 500 index, but we might need to craft our own benchmark that is reflective of those equity and fixed income and alternative investments that show up in our client's portfolio. So we need to worry about liquidity issues here, but we also need to worry about that appropriate benchmark. So this is a great exam question. You have a client, and the client invests in these 10 securities, so you get a sense of what those 10 are. What is the appropriate benchmark? And I'm guessing the Institute would give you 3 choices, A, B, or C, and I think it's an easy choice. Just pick the one that closely matches from a risk return or any of the segmentations that we did earlier in this slide deck. Boy, that's a really good question. Mandates, you probably get mandates from, let's say a pension fund. You might get it from a foundation. A foundation might say something like, you know what, I want you to go invest in stocks that have in companies where the executive leadership team has announced that they're going to be carbon free or net carbon zero by the year 2060 or whatever that number is. Or you might have a mandate that says, I don't want any tobacco companies, I don't want any alcohol companies, I don't want any oil companies. So that's where you go through that whole screening process. Taxes, we talked about that earlier. Risks of active management. Surely it's costly, right? If I'm the wealth manager and I'm spending all this extra time trying to match a portfolio with the client's risk and return objectives, I'm not going to do it for free. Reputational risk and key person risk. Those are obvious notions there. So notice these LOSs, they're all described. So what I want you to do now is I want you to go and I want you to answer those 8 questions at the end of this reading. I promise you, I don't even know if it'll take you 8 minutes. These are really, really simple questions at the end. So I want you to make a check mark next to all those correct answers and think about the Institute and the possibility that it's going to ask those 8 questions again on the exam, but with a different answer because the question stem is worded just a little bit different or the opposite of whatever that correct answer is. So know the correct answer and know what the next best correct answer is. So anyway, hey, this was fun for me. I hope you enjoyed it. I hope some of you raised your hand and said, hey, Jim, I didn't know that before. But clearly this could have been somewhat of a review. And I didn't keep you for the 2 hours of the last recording. So, hey, thanks for watching. Good luck studying and have a great day.